Fed has officially started the rate cut cycle, and in today's video, I'll be sharing with you exactly what are key details that you need to take note of. Asian markets have rallied across the board. Gold is right now at all-time high. Bitcoin is rallied hard also in the last few days. So I've taken the time to really specially prepare this for you, so let me smash the like button early. And as always, smash the subscribe button to keep up to date with new information on the financial markets. It starts with this. Fed actually surprised Wall Street with a 0.5% cut on Wednesday, and they brought down their target range to 4.75 to 5%. Now, this is actually a big cut because before this news, everybody on the market was speculating between 25 basis points, which is 0.25, or 50 basis points. So now that it's out finally, there's no need for further speculation. But actually on Wall Street, it doesn't end there. Everything is forecasting what's happening for 2025 and 2026, correct? And later, I have some numbers to show you. Fed Chairman Mr. Jerome Powell has mentioned he does not see anything in the economy right now that suggests a likelihood of a recession. Of a downturn that is being elevated. So can I use the recession now? That seems a bit taboo. We're talking about downturn. Next key part to note, we are not going back to the world of ultra low interest rates. Chairman Jerome Powell has mentioned that do not expect the era of cheap money to be returning anytime soon. He feels the neutral rate is likely significantly higher than it was back then, although he does not know yet how high it is. That is actually where the future speculation will lie. Will this neutral rate be 2%? 3%? We really don't know. Famous investor Howard Marks has suggested that 3% could be closer to what is a neutral rate than 1.5 or even 1%. But as we know, markets are very fickle. The tone we hear next year could be very different from what we hear right now. Moving on, the Fed's goal now is to keep inflation stable while simultaneously ensuring jobless rates do not tick higher. Chairman Jerome Powell has added that investors should take the Fed's 50 basis point cut as a sign of his strong commitment towards achieving this goal. This part on economy seems to be the key focus as to how much rate cuts will be upcoming. He's mentioned that the economy is in good shape right now and growing at a solid pace. Inflation is also coming down. However, inflation used to be the key worry, but quite obviously right now, job growth slowing is the key focus. US labor market is currently pretty close to maximum employment, but Federal Reserve is well aware that the job growth has cooled down. Clearly, payroll job creation has moved down over the last few months, and this bears watching. So I think this is a clue. If job markets start to weaken significantly, the pace for Fed rate cuts could be more aggressive. If it is roughly stable, we could see rates settling around 3+% at least for next year. Chairman Jerome Powell has mentioned specifically that he is in no hurry to ease policies. There is nothing in the SEP, which is the summary of economic projections, that suggests that the committee should rush to get a rate cut done. The so-called dot plot indicated that 19 FOMC members see the benchmark Fed fund rates at 4.4% by the end of this year, which is equivalent to a target range of 4.25 to 4.5%. The Fed's remaining two meetings are scheduled on November 6 and December 17. Through 2025, the central bank forecasts interest rates landing at 3.4%, indicating another full percentage point in cuts. Through 2026, rates are expected to fall to 2.9% with another half point reduction. So with this news, long-term bonds have actually sold down, creating a higher yield. As you can see over here, US 10-year yield has climbed up to 3.7%, which can be seen as an unexpected reaction after the news of rate cuts. This could also mean that the yield inversion cycle, which is when the short-term rates are higher than long-term rates, may be over by next year. It's not just the US 10-year rates. The 1-year, 2-year, and 30-year rates have all seen an upward tick in terms of the yield. Could that also mean that more institutional money is flowing out of the US, looking for assets overseas, like in Asian bonds or in equities in other countries? This hypothesis holds if we were to look in terms of the US dollar index, which has trended down very aggressively in the last few months. Reiterating on the pace of rate cut, Fed Chair Jerome Powell has mentioned, don't assume this is the new pace. The Federal Reserve cut by 0.5 percentage point on Wednesday, but investors should not assume that this pace would continue moving forward. We've waited, and I think that patience has already paid dividends in the form of our confidence that inflation is moving substantially under 2%. I think we are going to go carefully meeting by meeting and make our decisions as we go. This 50 basis point rate cut indeed is quite aggressive. As mentioned, in recent history, except for emergency cuts, this has been rarely observed. Some investors believe that the US Central Bank has jumped the gun with rate cut that was too big, too soon for the current backdrop. Chief Investment Officer of Americas at Morningstar Wealth has noted that half-point cuts have been rare in recent decades, adding that they were used during emergencies, such as COVID-19 pandemic and 2008 global financial crisis. He has further added that aggressive reduction indicates that the Fed has gotten comfortable that the downward trends in inflation are sustainable and now is redirecting to focus on pulling off a soft landing. Further comments from investment strategists. Fed cut may have been too aggressive, but this should support risk-on assets. This is by the head of investment strategy at Global X. There are not many indications that the economy is slowing in the most recent numbers. A larger cut was probably not needed out of the gate, but that should support risk-on asset allocation. Now this leads to the next question. How has the equity markets typically reacted to a rate cutting cycle? As you can see over here by Morningstar, in 1995 when there was a rate cut cycle, equity markets rallied 20+% in the next 1 year. In 2001, however, it was a negative. 2007, also a negative. But in 2019, that was a double-digit gain also after the rate cut cycle started. Now, some believe that rate cuts and equity market performance have no correlation if you look at data like this. But others feel that in an event where there is market crisis, rate cuts or not, they do not immediately solve the equity sentiment. But if we see in terms of 1995 and 2019, we would realize that rate cuts in these periods were when things were not in crisis modes. That has led to strong equity performances. Could we see a situation closer to these, where equities rally in the next 12 months moving ahead with this rate cut cycle that is happening when the economy is still relatively healthy? What about for bonds? BlackRock's CIO of Global Fixed Income has mentioned that this is a golden age of fixed income. With Federal Reserve cuts imminent, investors should make the most of this golden age of fixed income now. He believes that a shift is coming in the market where equities do not do better than okay, or tech stocks will no longer enjoy the fever pitch they have had. Instead, investors should buy yield and just watch it do its thing. It's an interesting point of view because bonds have came down significantly over the last 2 years. But again, he is from the bond markets. Naturally, he's more bullish on the bond sector. Personally, for myself, I'm still preferring equities. I see any weaknesses in the coming weeks ahead as opportunities to start buying further. So let me know your thoughts in the comment section below. With that, I'll sign off from here and see you in future videos. This is one on what to buy in the Fed rate cut cycle. I've covered on 4 asset classes. With that, I'll sign off from here and see you there. Take care as always. Goodbye.